The yield gap is the difference between the yield on a government bond, which is considered safe, and the dividend yield on stocks, which is considered a riskier investment. So that means the yield gap would be D1 over P0, where D1 over P0 is the initial dividend yield on the equity index. D1 over P0 would equal R minus G. G is the market's expected growth rate for equity dividends. So the expected growth rate for equity div. And R is the market's expected return for equities. So R would equal Y plus R star, and this R star is what's called the risk premium. So this is the risk associated with taking to doing the investment, and Y is the redemption yield of the government bond. So if we plug this R into our D1 over P1 equals R minus G, you're going to get D1 over P0 equals Y plus R minus G. And if we now rearrange this, you're going to get Y minus D1 over P0, which equals G minus R star. So this might seem a little bit complicated, but let's now get an example and plug it in. Let's take a 10-year government bond, and let's say that the annual return on that is going to be 5%. So this is going to be our Y value. And a company's expected dividends, let's say it's going to be £3. So the expected dividends of a company is going to be £3 or $3, whatever suits you. And the current stock price of that is £50 or $50. So now Y would be 3 over 50, which is going to be 0.06, which is 6%. So the yield on the private company is this. The government bond is 5%. So now all you would then do is do government bond minus the company dividends, which is going to be 5% minus 6%, which is going to equal to minus 1%. So why is this positive or negative aspect important? And the whole point of finding out the yield gap is because if it's negative, a yield gap means the stock offers a higher return. If it's positive, a positive yield gap means that the government bond offers a better return.